Are seeing some pressure today. This is the maker of computer chips, beating estimates for revenue and profit in the latest quarter, but investors focusing on the forecast. Micron issued a revenue forecast for the fourth quarter that was a little bit below expectations. Still, Micron is definitely getting a boost from the AI boom. Revenue increased a whopping 82% from last year. Meanwhile, shares of Walgreens tumbling. This is the lowest level for the stock since 1997. The drugstore chain cutting its full-year profit forecast, citing a worse-than-expected consumer environment, and says it expects headwinds to persist into 2025. Walgreens also reported profit in its latest quarter that missed expectations. The company says it's finalizing plans to fix its business that could result in the closure of hundreds more stores in the next 3 years. Now let's take a look at the market action. We've got the TSX, a rarity these days, the TSX outperforming those U.S. markets. You definitely have bond proxies that are doing well as bonds are under pressure. One of the significant contributors to the upside right now is actually coming courtesy of energy, but CN Rail, which has been under pressure, adding about 6 points to the index right now. Getting an upgrade from the analyst at National Bank, saying this is a buy the dip opportunity. Well, as we mentioned, the markets are in focus at this hour. We are seeing a little bit of pressure here. Earnings are one reason. Economic data has also not been terribly supportive. Today, we got another read of GDP. Personal consumption was revised lower. Factory sales unexpectedly declined for the month of May. And then you had continuing jobless claims hitting the highest level since 2021. It's against this backdrop that the markets have really been holding up. Let's bring in Gina Bolvin, who's president of Bolvin Wealth Management Group. Gina, thank you so much for joining us. Let's spend a beat on this consumer because it's been on their back that we have been really riding some of these gains. Well, that and artificial intelligence. How much of a crack are we seeing in the consumer?
Good morning, and thank you for having me back. It's so nice to be here. You know, we are seeing that the consumer is slowing. And really, I'm wondering, really what took so long. They have been spending money like crazy since the pandemic, and we're starting to see them slow. We saw that in terms of Walgreens come out today or slashing earnings estimates. We're also seeing that in Walmart and McDonald's that's coming out with value meals. We're seeing the consumer is under pressure. But while the consumer is slowing, we also see another side of the economy like travel picking up. In fact, Carnival Cruise Lines is booking into 2025. And just last weekend, TSA announced it was the busiest travel weekend ever. So while the consumer is cranky and not happy because inflation is still too high for them, they're still spending some money, but they're being a little bit more frugal.
I guess how much of a risk is this to the broader markets? Because if the higher end is holding up, if we get some sort of pullback in asset prices, does that introduce a vulnerability?
Some vulnerability into the consumer? Well, if you want to follow the consumer, you really need to follow the jobs market, because the consumer is actually 70% of the entire economy. But you really need to look at jobs. And as you mentioned, we did see initial claims inch up a little bit today. We are seeing some weakness in the labor market, but I don't think this weakness is recessionary. I think that this is happening finally after we've gone from 0 to 5 in historic record time on interest rates. And the question really is what took so long?
I think when we talk about the economic data like this, it actually makes sense that the S&P 500 on an equal weight basis has basically been flat, right? It hasn't had momentum because momentum in various parts of the economy is slowing. The market weight is doing fine because it's got the tech stocks propping it up.
Absolutely. To your point, the S&P is up about 14, 15%. The equal weight is up about 4%. And you have the NASDAQ up, I think it's over 30%. I think it's a little bit concerning, right? We want to see more of a broader participation in the market. And we started to see that earlier in the year. Then we had that correction in April, and the market has moved up again, but it's similar to last year. It's driven mostly by tech stocks. And we do like tech stocks, but it might be time to take a breather.
Take a breather and go where?
Well, there might be a correction in tech, but a lot of investors are used to this V-shaped recovery in technology and in the market, and we would be a buyer on any dip in the technology sector as well as anything else in the market. And one of the reasons why we would use any dip or correction as an opportunity is because we still see tremendous earnings growth. So earnings growth consensus for the S&P 500 for even into 2025 is double digits, almost about 14%. So if we go back to fundamentals and we're following some of the reasons to buy stocks, it really is about good and consistent earnings growth.
And do you think that those estimates for earnings growth are vulnerable? Do you think they're accurately reflecting some of the underlying weakness that we're seeing? Because it's one thing to say, yeah, we're expecting this kind of great double-digit earnings growth, but I feel like people always look at the back half with these rose-colored glasses.
Well, so say if earnings growth isn't 14 or 15% and it's 10%, we're still seeing healthy earnings growth. And let's also talk about consumer spending. Wage growth is slowing, which is going to slow demand, and that's going to contribute to inflation coming down. We have a big day tomorrow where the PCE is coming out, and we've seen 2 months in a row of softer data on inflation. And this is also going to help consumers in terms of purchasing power. So while we're seeing a slowdown in the consumer, we're seeing a slowdown in the economy, GDP is still positive and we're still seeing earnings growth. So a slowdown doesn't necessarily mean a recession.
Gina, thanks so much.